Hello. Last time I talked a little bit about live service games and why they are so popular, why everybody wants them. And as part of that, I talked a little bit about publicly traded companies and how they use these live service games as a backbone to make their decisions and to deal with what is a very volatile, risky industry. And I saw some comments that made me think, I guess I don't really, I shouldn't assume that everybody out there knows even what a publicly traded company is, how it functions, why it makes the decisions it does. And I talked about the word greedy and how I don't think it's super useful to add a human emotion component to this because it lets you say, oh, if only non-greedy executives were in charge of some of these companies, if only there were non-greedy people around, things would be better. And I don't think that's true. We're talking about systems here that are created by people and maybe greedy people, sure, but they're created in ways that incentivize certain behaviors that I think a lot of people would consider greedy, but calling the systems themselves greedy is kind of defeats the purpose. It makes it seem like if you were to replace, I don't know, the CEO of EA with someone who's not greedy, then you would get different results, which is not the case. Anyone who is running one of these companies is obligated to what's called a fiduciary duty, meaning they are responsible to make as much money as possible for their company and for their shareholders. So let's unpack all of that. Let's talk a little bit about what a publicly traded company is, how it fits into the world of gaming, and what that actually means. So there are essentially two kinds of companies, at least here in the US, which is the economic system that I'm most familiar with. Publicly traded companies and privately owned companies. A privately owned company is your friend's dad's business that, I don't know, manufactures rubber. It's the company started by a handful of people to do whatever, whether it's to make video games or make cars or, I don't know, publish books or anything else you want to do. It is generally a little bit smaller than a publicly traded company. And what is most important is that it is owned by just a few people. It might actually be big. A privately owned company can still be big. It might even have a board of directors. So it might be governed, might have the corporate governance of a traditional publicly traded company. But what's most important is that it is owned by a few people and not a public market. A privately owned company, you cannot just go on your E-Trade account and buy shares of it. It is not available on the markets. It cannot be traded. It is privately held. There are some companies out there and some kind of weird markets out there that actually let you take stakes in privately owned companies, but that's a whole nother story. For the most part, a privately owned company cannot be traded. It is privately held. If you own the majority of a private company, or if you are like generally the founders of a privately owned company are going to be the majority owners. They might sell off stakes as they try to raise investment. What's very common is if you are starting a company and you expect it to be big, maybe you're in Silicon Valley and you're doing some AI gold rush, you will sell a chunk of your company to investors, and in exchange they will give you a bunch of money that is kind of your seed capital, your money that you can use to grow the company and get the company going. And those investors will expect a return in exchange. They will expect you to go public or to sell the company, and then they will get a bunch of money in return. If you've ever seen Shark Tank, you can see this in action where you have these privately owned companies coming and trying to pitch the sharks to invest in exchange for a percent of their company, their equity. By the way, this might seem basic to some of you out there, but I think a lot of people just kind of don't know this stuff, and it can be helpful to talk about the basics, especially as it applies to the video game world, because you might see a lot of people out there just complaining about the way these companies work, and I think it's very useful to understand some of this stuff. So apologies if this is too basic for you out there. Private companies in the video game world specifically have some advantages. They can take more risks. They're owned by just a few people, and those people receive the majority of benefits, and those people can distribute those benefits however they want. So if you are a privately owned company and you're just 2 or 3 owners and you decide, hey, we're going to grow our company to be 10 people, you can decide, hey, we're going to give everybody a share of the profits. We're going to make sure everybody at our company enjoys the success. Like I said before, there might be a board of directors, but generally the founders have control, and the board is kind of, it could be kind of ceremonial, or it could exist to just kind of try to keep the founders in check. But if you own more than 50% of one of these privately owned companies, you are in charge. You can kind of do things how you want, as long as I guess there are exceptions to that. If you are if you are a minority stakeholder in one of these companies, you can ruffle some feathers and make some noise. But still, founders are generally in charge. Majority shareholders are generally in charge. And so in the games world, that can lead to a lot of cool stuff. I wrote an article a few years ago about how, I'll link this in the show notes. It's on Bloomberg. I'll throw a GIF link in the show notes, in the YouTube description, so you can read it for free. Baldur's Gate 3, despite being this massive AAA game with this huge budget and incredible production values, was actually made by a privately owned company called Larian. And I wrote this article about how that really was the secret to its success. I've talked to the CEO of Larian, Sven Vinke, a lot about this over the years. Publicly owned companies would not be able to make some of the, frankly, bonkers decisions that Larian has made, such as putting a game in early access for 3 years and letting people just play it and test it out, and potentially find all sorts of bugs along the way, or making a game where there's so many decisions that most players will never actually see all of the content, and some of the content that you've created that you put money into will only be seen by 0.0001% of players. These are the types of decisions you can only really get away with if you are a private company and you are not feeling the same kinds of pressures to kind of check the boxes and hit the same kind of expectation, hit the same criteria that everybody else is. So those are the advantages of being a privately held company. So why go public? Well, there are a few reasons. One is that doing an IPO, an initial public offering, and going public and starting to sell shares of your company on the market can be a good way to inject a lot of capital, a lot of money into your company. If you are trying to grow, and that is ultimately one of the main goal of a lot of these companies, most of these companies, is to grow. We'll talk about that in a second. But if you are trying to grow, you're trying to, make bigger games, you're trying to make more games, you're trying to expand your team so you can make higher fidelity graphics, then you need money. You need money to support that growth. And so you might choose to go public in order to raise a bunch of money by selling shares of your stock on the open market. And as a result, you will get a lot of capital that you can then spend to continue growing your company. It's kind of seen as a natural next step for a lot of companies once they hit a certain threshold of growth. Once they hit a certain number of people, a certain amount of EBITDA, which is essentially it's earnings before interest, taxes, and debt, which is essentially the Wall Street code for profitability, let's call it. So at that point, you might go public. You might also go public because you want to make a bunch of money yourself. And if you are if you are the owner of a company, if you have started a company and it has grown and you own a bunch of shares in it, those shares are only theoretical value until you either sell the company to someone else who will pay you money for those shares, or you put the company on the public market, in which case those shares suddenly become worth a lot of money. You might have seen headlines recently about how Elon Musk has become the world's first trillionaire. That is because all of the shares he owned in SpaceX turned into real money when he took SpaceX public the other day. So those are the advantages of being public. And in the games industry, where a lot of companies saw competing as kind of an arms race for graphical fidelity and for outspending one another, going public was a necessity, or at least continuing to grow on the public market was a necessity. A lot of these game companies like Ubisoft and EA and Activision and Take-Two had been public for a long time. And so what happens is you can just kind of keep outspending your way to success by being public. You have access to, nearly unlimited capital. It's not quite unlimited, but like as a publicly traded company, you can always do things. You can always raise capital in ways that you can't necessarily do if you are a privately owned company. Selling a bunch of shares, etc. And so if you are participating in this video games arms race, which I've talked about in previous videos, where we've seen how games have gone from costing $20 million to $200, $300, $400 million, you have to be public to compete with that. And you can just kind of you can brute force your way to success, outspend your way to success, which used to be more of a viable tool than it is today. These days, we are seeing a lot of these big budget games just die on arrival in a way that we had not seen in the past as a result of market forces that I've discussed before. But essentially, if you are a quote unquote AAA, if you are a big budget game, it used to be that you could just position yourself in Walmart and just by default you would get a bunch of people to buy your game. Nowadays, that is no longer possible. The field is more democratic. There are a lot more options for people. You have more cases like Concord, which of course I'm sure all of you out there have heard of, but essentially is Sony having spent a bunch of money on a game and sent it out, and it had so few players that they had to pull it from stores almost right away, which did not really happen 10 or 15 years ago, unless the game was so buggy and busted that people couldn't actually play it. But most of the time that did not happen. So what happens when you go public? You go public and suddenly your company can be traded on the market. There are all sorts of different kinds of markets that you could be trading on. Once your company is available for sale on the market, anyone can buy or sell shares in it. But what happens is that the majority of shareholders in these publicly traded companies wind up being institutional investors, they're called. And I pulled it up here. Let me pull up some of the top institutional holders. So a good way to think of this is that, like, when you have a publicly traded company, the bulk of its shares are going to these other kind of publicly traded companies, usually banks or equity investment firms, hedge funds, etc. So like if you pull up the stock for Take-Two, you can see this is all public. You can see its top institutional holders, and they are a few companies: BlackRock, State Street Corporation, Vanguard, JP Morgan Chase, Morgan Stanley, Saudi. That's a whole nother story that maybe we can talk about down the road. But the Saudi Arabia government has its own what's called a sovereign wealth fund that it has used to buy up all sorts of game companies and buy stakes in pretty much every game company. These companies, these institutional investors, are holding money and investing it from all sorts of different people. A lot of it is their own. A lot of it is from other institutions. There's kind of this like weird Ouroboros where everybody is investing in one another, and it's all what someone might consider a house of cards because everybody is propping one another up. And we've seen kind of the results of that with previous financial crises, such as 2008's big crises with Lehman Brothers and so on and so forth. But a lot of it is also retail investors. So when you talk about shareholders, you might look at something like BlackRock, which owns, I don't know, call it 10% of Take-Two. And a large chunk of BlackRock's holdings are pensions and retirement funds and people's just kind of like, I don't know, brokerage accounts with E-Trade or Vanguard or whatever. I mean, Vanguard is its own holdings in here. And so I believe, let me pull this up, according to a Gallup survey, 58% of U.S. adults are invested in the stock market in some way or another. So that might be you. When you are posting online about greedy shareholders, if you have a 401k, if you have an account with Vanguard or JP Morgan, you might be one of those greedy shareholders because it turns out that you're invested in Take-Two through some sort of ETF, which is kind of a collection of stocks, through the S&P, or even through just buying Take-Two on your own. Some people just go on one of these accounts and decide to buy stocks on their own, which, by the way, I would not recommend. I am not a financial advisor, but my advice would be to keep your stocks invested in broad portfolios such as the S&P, such as ETFs, such as any sort of kind of account that just has you riding the entire market rather than individual stocks. But regardless, shareholders could be anybody. So kind of saying, oh, these guys are obligated to please greedy shareholders is kind of a misleading statement. Now, what they are doing, and what a lot of these boards and CEOs and C-suite executives are doing all the time, is talking to people on Wall Street, which are these hedge fund investors and the people who are actually making decisions of how much to invest in these companies and how much to not. They're people who are making daily trades and buying and selling on the stock market and impacting the price of the stock market. Those are people who maybe you look at and you say, those friggin' greedy investors and traders or whatever. But they have their own kind of incentives and their own incentive structures, and a lot of what they're doing ultimately is on behalf of retail investors as well. Now, there are other, I think the kind of the core problem with this whole system, and really what a lot of people are getting at when they think about greed and they think about wealth concentration, is that the majority of the stock market is owned by a very small group of people. I believe the stat is that 90% of the stock market is owned by 10% of people. So while your average investor who has a 401k that maybe, if you're lucky, has a couple $100,000 in it, depending where you are in life, of course. But if you out there have some sort of investment, that is a very, very tiny slice of the pie compared to what the CEO of Take-Two has, which he's getting, the amount of stock that he's getting is in the tens of millions of dollars per year. So we're talking about kind of proportions here. That said, whether you are a tiny investor or a massive investor, Take-Two's stock growing benefits both of you. It just benefits the top a lot more than it benefits the bottom. And that fundamentally, I mean, if you want to talk about wealth disparity and problems in the US economy, that divide and how much it's grown over the last few decades, that might be what you want to identify, rather than just kind of saying greedy shareholders, which is kind of a meaningless term. One more thing I'll say is that when you are part of a publicly traded company, when you are running a publicly traded company, your North Star is growth, right? Because if I and I'm an investor and I have money parked in the stock market, I am doing that rather than just keeping it in a bank or a government bond or something, because I expect it to grow. I expect to see big returns every year. I'm hoping for 7, 8, 10% returns on that investment every single year. And so growth is the North Star. Growth is what these guys want constantly and what they're looking at. And so the kind of the goal of these publicly traded companies is to watch their numbers go up every month, every quarter, every year. They want operating income, profit to go up. They want revenue to go up. Ideally they want their headcount to go up, although also oftentimes they're also rewarded for cutting staff because Wall Street likes to see costs get cut as a result of that. But generally they want growth. They want their stock to grow. Now, what's really tricky and what's really fascinating to me, bonkers to me really, is that the performance of a stock is is tangentially linked and sometimes directly linked, but often not directly linked to the performance of the company itself. When I started at Bloomberg about 6 years ago, I was like, okay, cool. I'm working at this financial business news outlet. I will learn more about how the stock market works. And I think now, 6 years later, I feel like I know even less about how the stock market works and the whims and the magic that it adheres to. So the way that this kind of the ups and downs work are so mysterious and so nonsensical to me and to a lot of people that it's like, I mean, one of the reasons you don't want to day trade is because this is all just kind of nonsense. You might see a stock move for just the most inexplicable reasons, and it might just move by complete irrationality. What's that quote? There's this fantastic Wall Street quote about how, like, the market, I think this is Warren Buffett, is it the market can remain irrational longer than you can stay solvent, essentially saying that markets can be irrational for all sorts of reasons. But essentially the fundamental basis for stock movement is that every quarter, every 3 months, these companies operate based on fiscal quarters. So every quarter, a company will report earnings, which means that it will put out a whole set of documents that are like, this is how much we've made in revenue, this is how much we made in profit, this is how much we've had to spend in costs, and this is what we're projecting for future quarters and for future fiscal years. And Wall Street will look at that and compare it to their own analysts' estimates and say, hey, this is beating estimates, or hey, this is missing estimates, or hey, this is on par with estimates. And the stock will move accordingly. And sometimes, again, it will just move completely irrationally. Sometimes a company like Take-Two is a good example. They might say, hey, we missed estimates, but you know what? GTA 6 is still on track, and that's going to be the biggest game of the year. And as a result, maybe the stock will go up. Or they'll say, hey, we beat estimates, but actually we had to delay GTA 6, and so the stock will go down. And so, again, this is all just kind of arcane wizardry that is not really related to real life, which is why if you are choosing to invest, I implore you to invest in broad ETFs and S&P funds that are just tied to the overall performance of the market, which has broadly, I mean, over the last, 100 years or so, the overall market has broadly gone up, whereas individual stocks have gone in all sorts of directions depending on how they have done. One more thing I'll say real quick is that I think that kind of another model to all of this is employee ownership, which is something that I've really been keeping an eye on in recent years in the games world. Is this idea of a company not just being probably being privately held, but not just being owned in majority by its founders, but really everybody in the company gets a stake in it. And I've long wondered why more of capitalism doesn't just embrace that notion where everybody should have a stake in the company. Because I would think that, like, if every single employee in your company had a stake in seeing it succeed, then they would work harder. But that's besides the point. And that is, to be fair, that is why a lot of big companies offer stock incentives as part of their compensation packages, is to say, hey, well, if you do well, company does well, then you succeed. But at these big companies, I mean, an individual employee's performance is not going to impact the stock in any way. So that's, again, kind of just gambling. But employee ownership and just kind of co-ops and that model is also really interesting, and I think is something worth thinking about and examining. I'm very curious to see how that works in the games industry, how much we're going to see it, how often we're going to see it. I believe there are a couple of examples out there, one of which has since folded. Motion Twin, the company behind Dead Cells, I believe, is a worker-owned co-op, and they seem to be doing pretty well. Something I'm keeping an eye on. But in general, I just think it's worth understanding some of this stuff, and hopefully you out there have learned a couple of things from this explanation, because when you look at publicly traded companies and wonder how they work and why they operate in this way, this is why. Anyway, see you all next time.